Monica Malik is with me. She's the chief economist of Abu Dhabi Commercial Bank, joining me around the desk here in Abu Dhabi. Monica, good morning to you. It's so good to see you here in Abu Dhabi.
Thank you for having me on the show.
Now, we have so much to discuss. I wanted to begin our conversation, though, with what's happening in Turkey in particular. We've just seen this emergency rate hike taking place overnight, the lira in free fall, risk assets also on the move. Should GCC investors expect any kind of contagion in the region as a result?
From a macroeconomic perspective, the impact is likely to be minimal. However, a number of companies have been looking at Turkey for overseas expansion, and that includes banks. So if we see this volatility and lira fall continuing, that would, of course, impact the profits and the returns for these companies. But on a global basis, it just adds to more uncertainty, which I think will really define this year. And markets had, like Turkey, the orthodox monetary policy, but with concerns on the political environment, again, they need to have more certainty on this now.
You make an excellent point, because Turkey has had an excellent turnaround story over the last couple of years. We've seen the finance minister, Mehmet Şimşek, really trying to stoke investor confidence, bring in foreign investment. Do you think the credibility of the Turkish investment story has taken a hit as a result of what's happened in the last couple of days?
Absolutely. And of course, monetary policy is a key pillar to that, but so is political stability. And if you look decades back, one of the key problems for Turkey was the difficult political environment. So when Erdogan came in around 2005, that started a period of reforms because there was political stability. We've not had really the government instability, but again, if this comes back in with markets now really looking for the safe haven stories, Turkey, of course, will struggle if the political instability continues.
Indeed, so we're watching that really closely. Also, another major headline this week that's been capturing the attention of regional investors is the Fed decision to keep rates on hold. And given the currency peg, I want your take on what this means for growth and inflation dynamics in the GCC, particularly in the UAE and Saudi Arabia. The Fed's now projecting 2 potential cuts through the course of the year, but we still don't know the impact of those inflationary tariffs stateside. So the Fed really in a rock and a hard place. Where does it leave the GCC?
Well, absolutely. And, you know, the GCC really could do with a weaker interest rate environment. Oil prices have come down from the highs from 2002, and inflation is very weak. Apart from Kuwait, all the GCC countries have inflation around or below 2%. I think the Fed is very much on a wait-and-watch mode. We also see 2 rate cuts this year, but that would imply quite a soft landing for the US economy. Increasingly, we're concerned that the decision-making might be more binary, in the way that if you have a recession, it might be more, or if you have a stagflation environment, there might be none. For the GCC economies, what also is very important is the fiscal position and oil price. So it's really the investment program, government spending, GRE spending that's driving the credit demand. And for Saudi Arabia and UAE, we expect this to continue to remain strong, and we expect the strongest credit demand from these 2 economies.
Talk to me about the oil price environment as well. We've just seen these new sanctions on some of the teapot refiners. We have new OPEC plus supply coming through in April. Higher production, obviously good for volumes, but not so good for prices. So where do you see prices averaging out as a result?
Well, we've got our Brent crude forecast for this year averaging around $72 a barrel. And again, there's a lot of uncertainty both to the upside and downside. Downside, global demand. We are yet to see the impact of the rising tariffs, and this is an ongoing story. On the sort of upside, we've seen the sanctions, and I think you had mentioned the sanctions on the Iranian exports to the teapot refiners. And that isn't expected to have much impact by itself. But again, it's the fact that Trump is focusing on sanctions on Iran. So there's a lot of uncertainty. But for the Gulf, oil prices around $70 a barrel looks comfortable.
Indeed.
there are differences within the Gulf on the comfort level.
Yeah, indeed. I would agree with you. And I think looking specifically at Saudi Arabia, I think through the first quarter, there's also been some decent economic news coming forward. We've just seen this S&P upgrade to A+, the OECD growth revision moving upwards as well, plus higher oil volumes coming in play in April as well. So what's your take on the Saudi economy right now? And are we seeing enough traction, I guess, from the private sector investment side to justify the bullishness around the Saudi economy right now and the bullishness around Vision 2030? Because others have also told me, look, there's cracks starting to emerge in the Saudi growth story.
Absolutely. And I think on one hand, we do expect to see the investment program continuing to support non-oil activity. A key support factor for that is the low debt level, not only for the government, for the GREs as well, the PIF, Aramco, etc. So the ability to continue to invest. But certainly oil prices for Saudi need to be higher. There's also domestic cracks with capacity constraints, and that's being a headwind to the growth story as well. If you do see oil prices move below $70 a barrel, we would expect a further slowdown in Saudi Arabia, where non-oil GDP growth is very correlated, and they just do not have the fiscal space to continue to spend. FDI into Saudi Arabia has remained weaker than required for the investment program.